I had a dentist recently ask me about if he should invest in a single family home or not. He really didn't feel it was going to be worth it due to the small amount of monthly cash flow, about 600 bucks, that was going to be left over after he paid for his expenses. Unfortunately, his lack of information is what keeps most dentists and physicians and other high income professionals from building true wealth. And once he realized there was a potentially huge tax play at hand, he decided to actually buy the home. And in this video, we're going to discuss his exact situation and give you the numbers he was working with to start to build passive income. If you're new here, I'm Dr. Jeff Anzalone, a periodontist on a mission to get you out of the rat race with passive income. Do me a favor, like this video to give the YouTube gods some sort of algorithm that they use. I don't know. Just download the passive income guide below the video. All right. Let's break down his single family home purchase and look at some of his personal financial numbers. First, he was currently earning $300,000 a year as a dentist in Ohio. All right. So he goes out and he was wanting to invest in a single family home that was costing $350,000. If he put down 20%, which is $70,000, then he would have to finance the rest, which is $280,000 with the mortgage. All right. He projected that he could rent it out in his area for about $2,000 a month. That's going to give him a gross annual income of 2,000 times 12, $24,000. Now, if his expenses, including mortgage payments, taxes, insurance, maintenance costs, all of that, he projected them to be about $17,000 a year. So if you take the 24,000 gross annual income, potential gross annual income, and subtract out from the expenses 24,000 minus 17,000, that's going to give him a net annual income. So that's basically what he was projected to make after it's all said and done, after all the bills were paid, income minus expenses. So he was going to net $7,000 a year. Now, for tax purposes, he's going to need to depreciate the building portion of the property. So the IRS allows you to write off the wear and tear of the property. And for typical residential, it's what's called straight line depreciation, or he can depreciate the building, not the land, but the building 27 and a half years. So of the $350,000 house, assuming that the land is worth $70,000 and the actual house is worth $280,000, you take the $280,000, divide it by that straight line depreciation, the 27 and a half years. So he's able to depreciate $10,182 per year over the next 27 and a half years. Now, if he's in the 35% tax bracket, due to his high income, his taxes on the actual rental income, which is the $7,000 a year. Okay, so you take the net annual income, which is the $7,000 a year, minus the straight line depreciation times his tax bracket. Well, he's not paying any taxes on rental income, which is one of the reasons why you want to invest in real estate to begin with. You see that you really don't pay any taxes on this income, which when you do this calculation, it actually gives him a passive loss of 3182. So this is what's left over from subtracting out the net annual income minus depreciation. So this is what's left over, and this is actually what's carried forward. Okay, so he has a passive loss of 3182. Now, because he's not a real estate professional, he would not be able to fully offset or use this against his dental income because of the passive activity loss rules. So again, this is just going to leave him with the $7,000 in cash flow. All right. Now, in his situation, he had a spouse that she was only working part-time. And now that they were going to become an active real estate investing couple, family, whatever you call it, they wanted to explore a couple of different situations. All right. They wanted to explore real estate professional status. They wanted to explore being able to accelerate this depreciation with cost segregation study. What we're going to break down next: cost segregation study and real estate professional. So cost segregation study, what is that? So that's like think of it like a detailed inspection of a property that you bought. So it's kind of like, at Halloween, sometimes you want to give out, well, I know when we used to give out candy, I wouldn't want to give out the same thing. I didn't want to give out just a bunch of M&Ms or just a bunch of Snickers or Twix or whatever. I want to give out a little bit of everything. So you know how you can buy those big bags of candy with, one bag with a little bit of everything in it. Okay. So think of the cost segregation study kind of like that. It's kind of like if you had that bag with all of these different types of candy, and you go in and you separate it out. You put all the M&Ms over here, you put all the Rolos over here, Milk Duds, whatever. Okay, so you're separating it out into different types. All right. So imagine that you've bought a building that's a mix of all this different parts or candy or whatever you're saying, but all the different parts are going to be like walls, carpet, roof, electrical system, appliances, things like that. So normally when you buy a property, you think of it as just one big piece, one big house, one big whatever it is, apartment, whatever. And the tax rules say that you can actually deduct a little bit of its value from your income, again, for 27 and a half years if it's residential property, or 39 years if it's commercial property. But what if some of the parts of that big piece that, let's stick with the single family home. What if some of the different parts of the single family home, again, like the carpet or the electrical system, won't last 27 and a half years? Well, if you're from Louisiana like me, carpet may last 27 and a half years, but that's another discussion for another video. So if the carpet or electrical system won't really last that long, this is where the cost segregation study comes in. It's actually done by a specialist, the group that we use. I'll leave the link below this video. I've used personally for several RV parks and mobile home parks. So this group, it goes out and they come in and they break down the cost of the building into all of its different parts. So they identify things that are actually going to wear out more quickly. Instead of appliances lasting 27 and a half years or landscaping, carpeting, whatever, they break it out and they say, hey, these things are separate. They're going to wear out quicker. They're going to have a shorter life. Does that make sense? So the carpet isn't going to last 27 and a half years. It may only last 5 years. So we're going to put it over here in this 5-year bucket, or this 7-year bucket, or this 15-year bucket, whatever. So the IRS allows you to take bigger deductions each year for the things that have a shorter life. Again, so instead of waiting 27 and a half or 39 years to get all of your deductions, a cost segregation study lets you get some of them much sooner. Why is this important? This is important because now you can accelerate the depreciation, which allows you to save a lot more money on your taxes and improve your cash flow. That is the cost segregation study. So now let's move on to the real estate professional tax status. This is a special classification by our friends at the IRS for people who spend a significant amount of time on real estate activities. I'm not a tax person. I'm not a CPA. I'm not a financial advisor. All of this information that we're talking about today is for educational purposes only. Speak with yours if you have any questions about anything that we're talking about. So, real estate professional status, it's for people who spend a lot of time on real estate activities. Think of it as like a frequent flyer status. They're frequently flying, but for real estate. So here's how it works. So normally, if you have a rental property like this guy over here that loses money, okay, if you have a rental property that loses money, you can't use that loss to reduce your taxes on other income. So because he's not a real estate professional yet, he's not able to use these losses that he's getting. So this passive loss, he's getting this depreciation. He's not able to use this against his $300,000 income. He's not able to do that. And I think a lot of times that's a misconception. So he can't use it to offset W-2, 1099, or other business income. These losses are often suspended and then used to carry forward in future years. So if he stays like this, so then the next year this carries forward to help offset the rental income. So if he starts to increase the rents and he gets more and more rental income and his expenses, so if he increases the rents and expenses come down, this number is going to go up. Thus, he'll keep being able to offset that income. But if he, as his family, qualifies as this real estate professional, the IRS now unlocks those passive losses. So it allows him to start using these losses right away to lower taxes on other income. Now, to qualify, you've got to pass 2 main tests. Number 1, you have to spend at least 750 hours a year, needs to be in real estate trades or businesses where you materially participate, where you are managing the property. You're there, you're dealing with tenants, he has a single family home. He is working on it. He is materially participating. Okay. So at least 750 hours and need to spend more than half of your time on these real estate activities than any other personal services. Because his wife now works part-time, one of the things that they're going to talk to their accountant about is having her meet these requirements. If she spends over 750 hours and more time than her part-time job, then whenever they file their taxes, they're able to, that tax return now could be real estate professional status. Even though she's the one that's doing all the work, those losses that they're going to get will offset their household income, which is going to be his $300,000 or more dental income. Okay, this is huge. This can be a big advantage for somebody who's actively involved in real estate, again, because it can reduce their overall tax bill significantly. All right, they go in, so this is scenario one. So they go in scenario two and they do a cost segregation study. That study finds that $70,000 of the property. So remember, we were using 200. We said that the land was worth $70,000 and the actual property was worth $280,000. So of that $280,000, the cost segregation study, it segregated out, it selected out that, hey, you know what? $70,000 of that $280,000 can be reclassified. So instead of 27 and a half years straight line depreciation, depreciating it, writing it off, however you want to say it, it said, hey, $70,000 of that $280,000 property can be classified as 5-year property. So now they're able to depreciate. You take 70,000 divided by 5. Now this person can depreciate $14,000 per year on these items. All right. So if you take that amount and you add this to the normal building depreciation, remember that we got right here, straight line depreciation to the $10,182. So the $10,182 plus the $14,000, it gives us this number right here, a little over $24,000. Now the tax, now calculate the tax owed. So you've got the net annual rental income, subtract it out from this number times his tax rate. Again, he's still not paying any taxes on the rental income. All right. But what this does, it increases his loss. So now instead of his passive loss being 3182, now the passive loss is 17,182, which can be carried forward. That's after the cost segregation study. You take that, you combine it with them being a real estate professional, filing as a reps or real estate professional status. Now they can take this loss, they can take this passive loss and use this to offset other income, because now that there's not subject to the passive activity loss rules. Okay. Again, so the other income, remember, was $300,000 as a dentist. So you can take $300,000, subtract this. So now they're only taxed on $287,818. So at the 35%, so now let's do a little bit of math. So you've got the passive loss multiplied by 35%, they're in the 35% tax bracket. That's going to give them $6,000. So that's a tax saving of basically $6,000 more because they did a cost segregation study and real estate professional status. So remember, to go back to the first point of this video, he didn't think it was going to be worth it to get the single family home because he was only going to be making about, remember, $600, roughly about $600 a month, or $7,000 a year. But now, not only is he able to do that, they're able to do that. So they have the rental income of $7,000 plus the tax savings. So they have this tax savings of $6,000. So when you add those two together, so when you take 7,000 plus this, so now they're looking at, let's see, that's going to be 13,000. I'll do the math right there. Okay. So now they have a total annual cash flow from that of 13,000, a little over $13,000 a year compared to the 7,000 the first scenario. Okay. Again, this is a very simplified example of one single family home. I'm not talking about all the different other things you can do. This is just, I want to break this down in simple terms from you, because more than likely nobody's teaching you this. I know your accountant's not teaching you this, because what does your accountant want to do? They want to talk to you around February, maybe January, February, hopefully not March. Get all of your stuff in so they can input the numbers in and tell you the tax they owe. They're not telling you, they're not giving you these strategies. Again, I'm not an accountant, but it's kind of like, if you want to be successful in life, then you're just going to have to take control. Nobody cares more for your money than you, not your advisor, not your accountant, nobody. Okay? So you need to be the one to take control. If you don't, then you can just keep paying a buttload of taxes, keep working, and just life goes on. That's what the majority of people do. I don't want you to be the majority of people. Okay, and again, always seek professional advice before making any investment decisions, implementing any of this stuff. Okay, so I know we briefly touched on cost segregation, real estate professional, all this, but if you want to take a deeper dive into this topic of being able to use real estate to avoid as much of the W-2 taxes that you're paying right now, check out this video.